So let's talk about things that are working and not working. Let's go to Rockwell Automation. So that company is a really great indicator of sort of end user demand. It provides control devices and software for industrial automation. Now, it reported earnings yesterday, and it tumbled the most intraday since 2022 because its fiscal first quarter profit did actually miss estimates. The stock now up by almost 3% today. We are now joined by the CEO, Blake Moret. We're really great to get this perspective. Hey, Blake, what do you think the market took away yesterday from your earnings?
Well, I think they did hear the message of continued underlying demand remaining strong, but we had a shipment miss in the quarter. A lot of that was execution, and we look at that as timing for shipments that will come back in the year. You know, we had very strong growth last year of 17% top line, 28% adjusted EPS. This is a bit of a reset year as we get done shipping off that older backlog that piled up as a result of supply chain shortages and go back to booking and billing incoming new orders. And so we're seeing lower growth in the year with some growing pains, but the underlying demand remains pretty strong.
That's kind of where I want to go, Blake. What are your tell us and our listeners and our viewers, like, who your customers are and what are your customers telling you these days?
We may be the most pervasive technology in American manufacturing. So everything from automotive and battery manufacturing to warehouse automation, food and beverage, life sciences, energy, both traditional fossil fuel as well as renewables. Across that whole spectrum, our technology, our hardware and our software and our services are pretty prevalent.
So when do you know, Blake, if it's still the supply chain issues that you're still working through versus just weaker demand? Like, do you even know when that moment shifts?
Well, so we had an encouraging quarter in the demand side in that in Q1, so the quarter ended in December, we did see double-digit sequential growth in orders off of the trough in our fiscal year, our fiscal Q4 last year, and those orders increases have continued into January. So that's a very positive sign. Now, a lot of our distributors, and most of our business does go through electrical distributors, they had higher inventory than they wanted, and we expect in the coming couple of months that that inventory gets to more of a normal level so that their orders to us reflect the strong underlying demand from machine builders and end users.
Blake, how much lead time do you have in your business? What's your order book and kind of how much lead time do you really have?
So the product business, which is the majority of our business, those lead times are typically days and weeks in a normal period. And part of our challenge in Q1 was returning all of our products to those fast lead times. But in a normal, environment, we get an order and it either gets shipped that day off our distributor's shelf, or we're able to make it and ship it within days or a few weeks for those products.
So are you an early cycle economic read? Is that fair to say?
You know, we certainly have exposure early in the cycle, but the so-called late cycle is also an important part of our business. Whether you're talking about the traditional process industries or life sciences, we've got pretty broad exposure early, mid, and late cycle. Although I have to say, with the supply chain backlog that we had in 2022 and 23, with the distributor overstock that we're working through now, it's hard to pin a particular point in this traditional cycle on this time.
Well, also because you're exposed to sort of all the structural changes too, like Infrastructure Act, the CHIPS Act, the IRA. So that's a structural shift, even though you're still cyclical. I can imagine that being quite confusing. So based on where you are in all the different cycles, how are we doing? Like, how's the global economy doing?
You know, particularly in our home market in the U.S., where we have the largest market share, we see continued strong underlying demand. So we're expecting our orders to be up low single digits, and we've guided to 1 point up in terms of organic shipments. But that underlying demand, I think, remains strong. And one of the key indicators for me is continued low unemployment rates in our most important markets.
So, Blake, I'm looking at the PGEO function on the Bloomberg terminal, and I can see just by geography, looking at your revenue, again, 60% roughly of your revenue is North America. So give us a sense of kind of North America versus rest of the world. What are you guys seeing?
North America is the strongest market.
Yep.
China has significant problems right now, and Europe still dealing with some of their structural issues. A lot of the business we get in Europe is actually for export back to North America from the machine builders over there. But we expect for this year, North America is going to be the strongest market. And that's good for us because we've got home field advantage.
This feels like a U.S. exceptionalism conversation, right? Yeah. like yet again. So if we just go macro then for a minute, if the Fed cuts rates in May, what does that do? Like if you're already seeing U.S. Hold up pretty well, does that accelerate the economy from where you stand?
I think that could help some of the largest CapEx projects, which, we get some business from, but we're not as much of a CapEx play as, some other names, in that we're pretty balanced between CapEx as well as OpEx in terms of improvements, additional efficiency in existing facilities as well. So I don't know that interest rates are our biggest indicator. As I said, for the economy, I look at unemployment, and I look at the amount of automation investment, both for new greenfields as well as adding efficiency and resilience in existing facilities.
Blake, just explain to us kind of what your competitive marketplace looks like. Where are you guys versus your competitors? Who do you compete against, and how is that changing?
So our big competitors are mostly the European conglomerates, really. It's Siemens, Schneider, ABB. In certain narrow parts of the market, Honeywell and Emerson here in the U.S., where really, we distinguish ourselves by having a very balanced exposure from discrete applications like automotive to hybrid applications like food and beverage and life sciences to continuous process applications like energy and mining and so on.
Hey, Blake, to that point, Honeywell's not having a good day after reported earnings, one of the worst performing stocks in the S&P. Siemens Energy, part of Siemens, had just been really hurt by offshore wind here in the U.S. I should say not owned by Siemens, but Siemens owns a stake in Siemens Energy. What's your view on the energy green transition build out right now? Are you losing money? Are you making money? What does your order book look like?
It's still early innings, but we're seeing good business as a result of energy transition. And I would bucket it in three different ways. I'd look at first the decarbonization of the traditional oil and gas companies, so carbon capture projects. We've talked about the work we're doing with Occidental and their direct air capture projects, the 1.5 initiative. It's renewables, and again, we've talked publicly about what we're doing with companies like First Solar in creating, PV panels. And then it's the thing that we've been doing for our entire history, and that's driving efficiency across all manufacturing. And those are all good applications for us. There's some relatively nascent areas like hydrogen that are sources of optimism, but I would put them in those three main areas.
Hey, Blake, I'm looking at the ANR function on the Bloomberg terminal. It shows me that there are 11 Wall Street analyst buys on your stock, 12 holds, and 5 sells, so pretty mixed across the board. What's the message that you bring to your investors into the marketplace?
That the underlying demand remains strong, that we really have a unique position among all of those competitors and among the niche competitors. I like the hand we have. And as manufacturing picks up and resets from the period of supply chain shortages, we're in a great spot to accelerate our profitable growth.
Before we end here, we have 90 seconds left. You mentioned jobs quite a few times. We have the jobs data tomorrow. We got initial jobless claims rising the most since November today. What is your assessment of the labor market? Hard to get? You're going to keep labor, paying more? What do you see?
I think in manufacturing workforce, there's still a lot of unfilled jobs. And we think that, having a skilled workforce is absolutely essential for manufacturers to compete, but it's augmented with the kind of technology that we offer. So it's really that winning hand of having an enabled and engaged workforce, and we do a lot to help with workforce development, and it's also given them so-called superpowers with the technology that we offer.
Superpowers. Sounds great.
Can you find, like here in the U.S., can you find people for your type of work?
Certain jobs, it takes longer than in others. We're actually helping with workforce development programs that we offer in-house and then provide labor, particularly focused towards technician level jobs for manufacturers in America through our Academy of Advanced Manufacturing.
Interesting. All right, Blake, we really appreciate your time here. I know you're busy with the earnings and running a business. Blake Moret, Rockwell Automation. He's the CEO over there. ROK is the ticker for the stock, and the stock's down about 16% year to date. So I guess a lot of investors are waiting for that manufacturing turnaround. We did get some better ISM manufacturing data, and we'll talk to Tim Fury coming up on that. So we got it still in contraction mode, but getting better. So again, a lot of investors probably looking for that turn in manufacturing when looking at a company like Rockwell Automation.